Good morning, everybody. And there are 20 students today. Okay, good. We are going to discuss about the accounting principles. Accounting principles. Okay. Now, the accounting principles are broadly divided into accounting concepts and accounting convention. Concepts and conventions. Okay, accounting concepts and accounting conventions. What is a concept? It's a postulate. Okay, it's a necessary assumption, right? On which this is a premise on which the accounting is based. Okay, and when it is convention, it is a custom, it is a tradition, it is a practice, right? Every time we go to meal or eating food, we wash our hands, right? The reason could be it is to ignite the appetite, when the tips of the fingers are touched with water and, your appetite begins to, activate it. That's one reason. Another reason is that if there are any germs or, on your fingers and hands, you can wash them off before you take your food. That's a convention, that's a practice. Who taught that? Our parents. Who taught them? Their parents. Who taught them? Their parents. Who taught them? Their parents. Their great great grandparents. Okay, so this is a custom. This is a custom, right? There's a convention. So similarly, there are many accounting issues that we have seen all these 45, 50 sessions, right? And all these 45, 50 sessions, there are so many issues. Okay, we were perplexed with so many, items, whether to treat it as a revenue item or a capital item, whether to, go with depreciation of diminishing balance or straight line method. So which method should we go? So we were confused. So over a period of time, there is a convention developed. There's a practice, best practice is adopted, right? The best practice, proven practice is convention. Okay. If it is a concept, if you're asking me about concept, it is just a postulate. It is a premise on which the accounting, the whole accounting hinges on. Okay. Now, so these are accounting concepts. Accounting concepts. What are these accounting concepts? Business entity concept, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, accounting period concept. Okay, so business entity concept, right? Business entity concept, money measurement concept, cost concept, dual aspect concept, realization concept, accounting period concept. Coming to the convention, convention of consistency, convention of disclosure, convention of conservatism or conservation of. Now let me call it conservatism. Okay, let me call it conservatism. Now let's look into the details. Okay, I told you about this, what a concept is, right? The first concept being business entity concept. Entity concept also it is called business entity concept or entity concept. Okay, what do you learn here? You will learn, you will understand that business is separate from its owner. You cannot say business and its owner are same. They're not one entity. They're two different entities. One entity is created by the law of land. Another entity is created by God. Natural man, natural entity, and there is uh, artificial or legal entity. Legal entity. Okay. Now, why this treatment? Why this treatment has to be given? That owner should be separate from his business. let me say, how many participants are here? 20, right? 21 as of now. Let's say Aryan Saluja has a business, okay? And he has a business. What is that? Travel business. And he, he has buses, he has, cars, motor cars. He has a travel business. So we are all going for a picnic. And uh, yeah, then Aryan, we asked Aryan, can you send your minibus, 25-seater we want. We want one 25-seater and one 6-seater. So we are totally 30 people, right? And we want two vehicles, right? And if Aryan says, sir, since you're my teacher and you're all my friends, he says to the class, you can take it, just fill the fuel and take the vehicles. If Aryan says like that, then he's not fit to be in the business. He's not doing justice to his business. Or if Aryan says, so this is the fare, okay, these are the charges. Okay, if you want 25-seater, this is the price. If you want 7-seater, this is the price, he says. And if you want two vehicles, this is the total amount that you have to pay. But what we are trying to say is, there's something called undue influence. Just because he's a student or friend, we say we have this influence over him, undue influence. We blackmail him emotionally and say, hey, Saluja, you're our student, okay? And we want it to be free, right? After all, we are all your students. Now you may get a discount of 10% or 15% or 20%, whatever discount that is applicable to all the customers, or maybe another 5% you may exercise. But asking completely free is ridiculous. It is injustice to the business. Okay. So therefore, what uh, when you're trying to say, Saluja, we want it free, then Aryan says, I'm sorry, I can't do injustice to my business, right? And you all come to my house and I'll serve you with biryani, Hyderabadi biryani, but I cannot do injustice to my business. 10,000 is the fare for 25-seater and 4,000 is the fare for 7-seater. That's it. 14,000 you had to pay and you have to fill the tank on your own. Okay. This is what he says. What is this he's trying to say? Even when I'm taking my relatives, okay, even when I'm taking my relatives in these cars of my business, I will treat it as, I will account it as my personal expense rather than treating it as business expense, right? So every time he is using it for his personal purpose, it is withdrawing the revenue from the business. Let's say if the same facility is given to the outsider, if it fetches 10,000 for 25-seater, and if you're giving it for free or using it for your family purpose for free, and the 10,000 of revenue is gone, and who will bear that? Okay, where do you account for? Right. So you cannot include all your personal expenses of your family into the business, nor you cannot include your company's expenses or receipts in your family matters. You have to make a clear distinction of your business and yourself, your business and your family. This is business entity concept. Now read again. I want somebody, yeah, Rohit G will read this. Rohit, Rohit, Rohit will read it. Yes, sir. If Rohit is not responding, he'll be removed.
Yes, sir.
Yeah. Read it.
Sir, 1 minute, sir.
Okay, you have a difficulty. Jay, you start Jay. Jay Kishore.
Yes, sir.
Hmm.
Business entity concept. Business is treated as a separate entity or unit apart from its owner and others. All the transactions of the business are recorded in the books of the business from the point of view of business as an entity. And even the owner is treated as a creditor to the extent of his or her capital.
Okay, even the owner, this is what the doubt asked by many people. This is what the doubt asked. Sir, capital is the owner's contribution, right? Why do we drop in liabilities? Liability is something that is obligated to outsiders. Okay, but owner is part of the business, right? Why do you put owner's capital also into liability? That's not liability. This is the contention of some students. But we say, yes, this is liability. Why? Because the owner is extending his financial resources to the business and treating this business organization separate. It is completely separate. Okay. For the company, it's a liability. It's a liability. As he's extending capital, as it is liability for the company, whenever the owner takes away money, that is deducted from his capital amount. That's called drawings, right? We have discussed exhaustively about drawings. Drawings can be in terms of cash, drawings can be in terms of asset, drawings can be in terms of material. Okay. So to that extent, the amount is deducted from the capital. Okay. So as he's putting in money, that's a liability. As he's taking away money, that's a drawing. And drawing is deducted. Let's say 10 lakhs is invested and 2 lakhs is withdrawn. Okay, 2 lakhs is deducted from the capital of 10 lakhs. Okay, the total capital value comes to 8 lakhs. Okay, let's go to the next concept. Next concept. Money measurement concept. Money measurement concept. Right? So, the employees of a company are very loyal to the company. Okay, the staff of a particular department are very disciplined. Okay, and this store's manager is a man of integrity, very honest gentleman, right? All these things are very vital for the success of the business organization. But can you record these things in the books of record accounts? Can you record? No, it is not possible. Now, if at all, if you want to record in the books of accounts, it must be converted into money terms. It must be converted into money terms. Only then you can record in the books of accounts. Okay. So anything that cannot be converted into cash or money terms cannot be recorded in the books of accounts. Okay. Right. So can you read it? Any of you? This paragraph? Yeah.
Sir, may I?
Yeah, please. Yes, ma'am. Go ahead. I think you're speaking with mute, Amdo. Please check your mic.
Sorry, sir. Money measurement concept. In accounting, we recorded only those transactions which are expressed in terms of money. In other words, a fact which cannot be expressed in monetary terms is not recorded in the books of accounts.
Goodwill, a reputation of company is called as goodwill. Reputation, if you say it cannot be recorded, yes, convert that reputation into money terms. And you are calling it goodwill. And goodwill, which carries money value, only can be recorded. But if you simply say, my company has a very good reputation in the market, okay, you can't record that, right? It must be converted into cash. Only then you can record. Right. Next. Good, but thank you. And Aditya will take up the next one. Aditya, you better read it, then we'll discuss this.
Yes, sir. Accounting period concept. In accounting, life of the business is perpetual, but still it has a report that results of activity undertaken in 1 year So final accounts are prepared for the accounting period, which is 12 months period, and normally is the financial year, 1st April to 31st March.
Yeah. Look at this. There's another concept. We'll come back to that. Before that, there's accounting period. We set up the company with an intention that it runs into perpetuity. But to know periodically about your performance, you had to cross check. Let's say at the end of third year, I'll give you BCom degree. Okay, BCom degree. And will anybody do anything all these 3 years for 6 semesters? I don't think. I don't think that you'll put in enough efforts, right? So every semester, your performance is examined. Semester exams are conducted. There's a beginning point, there's an ending point, right? There's a beginning point, there's an ending point for every semester. And likewise, there's a beginning point for your BCom program, BCom computers, and there's an ending point, BCom computers final semester, right? And you will get a score sheet for 6 semesters for all your courses, all your subjects. So, your performance is measured with what? With a period, right? There's a period, there's a time span. There's a beginning point, there's an ending point in between. How did you do? To know that, there is an examination. And what is examination for a business organization? The result of examination, the performance of the company is reflected in the profit and loss account and in the balance sheet. Okay, the financial results are declared by so-and-so company about, okay, and the results of Infosys are declared. What is that? What is that? There's an accounting period. There's a starting point, 1st April of the previous year and 31st March of the next year. And in between, you have 12 months. For these 12 months, what's the performance? What's a profit made? What's a loss if there's a loss? And what's the position of assets and liabilities? To know that there's a beginning and ending, and in between, what you call is span or time period. So therefore, accounting period. So the accounting period concept says there should be a time span. The time span can be a quarter of 3 months. Time span can be, for 12 months, a year, a half year, for 6 months. There must be a time span generally in India for 12 months. Okay, so every year we make out our results. At the end of every 12 months, we make out our profit. We calculate, we ascertain the profit. Who will take the next one? Who will take the next?
Sir, I will.
Yes. Yeah, go ahead.
Cost concept. Transactions are entered in the books of accounts at the amount actually involved. Suppose a company purchases a car for rupees 1,50,000, the real value of which is 2 lakhs. The purchase will be recorded as 1,50,000 and not anymore. This is one of the most important concept, and it prevents arbitrary values being put on transactions.
Yeah, that's good. Look at this now. What Sabri, is it Sabri?
Yeah, yes, sir.
Okay. So what Sabri says is, what he has read, in fact, is, you have to record only that amount you have spent to procure an asset, to buy an asset. Okay, after you buy an asset, it may get inflated, right? And that is immaterial for you. That is immaterial for you. Okay, I was asking, I told you this earlier also. I was asking, there's one company called IDPL, right? I told you, I think in the previous example, this company, is closed 20 years back, even before you were born. And the properties of this company, the land, is from Musapet to it. There are hundreds of acres there, and it ends. Where is that? Chintal, IDPL township. That all that IDPL township, hundreds of acres, belonged to this IDPL. There was a company, Indian Drugs and Pharmaceuticals Limited. Okay, he was a drug manufacturer under central government of India company is this. And all these today companies, what all you companies that you see, Dr. Reddy's, Cetro Drugs, Aurobindo, all these were scientists earlier. The owners, the promoters of these companies were scientists in the IDPL. So they came out and started their own companies, and this company went into loss. Okay, then I was sharing, or rather I was asking doubt to my teacher, just like you when I was studying. So, that the value of the land is so much, and how can they say the company is in loss and the company is closed? Even if you sell 1 acre, it is crores of rupees. Okay, maybe 100 crores. So why is it the government is not doing that? And my teacher was saying, it is not about the real estate. This company is into the drugs, okay, pharmaceuticals and drug making. And the business of this company is not into constructing or dealing with real estate, lands and buildings. Had it been there like that, so what you are saying is correct. But for now, for the company, the cost at which the land is acquired and the value that is recorded in the books, that is what important, not the inflated value over the years. This company is there for the last 40 years. So in this 40 years, the company's land value might have gone up exorbitantly. Okay. So that is not to be considered. What is the value? What is the money that you have paid? What's the cost you have incurred to buy that land? That is what you will record in the books of accounts, not the inflated value. Do you understand? In simple words, we record only the cost that is incurred, not the market value. Do you understand that? This is what the cost concept says. In accounting, we record only the cost that we incur, not the market value after that is acquired. Let's say after 5 years, the land value may go up. That is immaterial for us. Okay, in the books, whatever you have paid to buy the land, that only is recorded. In this one college at JNTU, okay, and when the government has allotted 5 acres of land for that college, right? Um, 5 acres of land, and at what rate they have sanctioned the land? 1 rupee per acre. Per acre is nearly 100 crores, and the government 30 years ago, government of AP at the time sanctioned the land at 1 rupee. At 1 rupee. That means for 5 acres, 5 rupees. The land value in the books of that college will be only 5 rupees, not 500 crores, which is market value now. That is what I want you to understand about the cost concept. Okay, now let's go to the next one. Going concern concept. This I already told. Would anybody read it for me? Will you please take up?
Yes, sir.
Yeah, yeah.
Going concern concept, it is persuaded that the business will exist for a long time and transactions are recorded from this point of view. The entity is assumed to remain in operation sufficiently long to carry out its objectives and plans.
No company is set up, thank you, ma'am. Good. No company is set up with an intention to run only for 5 years. Nobody intends to do that. Okay. Everybody intends to do the business forever. Okay. As long as it is possible. Right. Jamshedji Tata, when he has started the business, steel industry, okay, it is not for himself or only for his tenure. After him, then his son, JRD, and after him, JRD's son, Ratan, and it went on. If not JRD and Ratan, somebody else will come up and take over, right? When Narayan Murthy started the business of Infosys, it is not only for himself, only for his time period. Business is set up. It's an organization. It's an entity created by the law of the land, okay? And it should be it should be wound up only by the law, not by humans. The law created a company, an entity, and the same entity can be closed only by that law. God who created man, okay, will only take the life of man. No man can take the life of man, right? Okay, you may think, or somebody may think that he is murdering, but no, it is a God who takes away the life, right? There are many cases, in spite of very grievous wounds, there are people survived even till today, right? The life is in God's hand. So the one who has put life in the body, he has the right or authority to take that life also. Just like that, the law that creates a company can also possess the right, it does also possess the right to take away the life in the company or close the company, right? But as long as the operation of the law begins, the company continues to exist. And the intention is to continue it into perpetuity for a long term, forever and ever, the company, continues to exist. But let's say, sir, there are some companies, they are closed within 2 years, within 3 years. What are those? They're projects. You can't call them as companies. They're projects. Let's say Metro Rail project. It's a project. Okay. Projects are short-term endeavors. Short-term endeavors. But a company is it runs into perpetuity forever and ever. Right. Next, who will take up this?
Dual aspect concept.
Yes.
Each transaction has two aspects, that is, the receiving benefit by one party and the given benefit by the other. This principle is the core of accounting.
There's a benefit giver, there's a benefit receiver. For every debit, there's a corresponding and equal credit. Okay. If there's a giver, there's a receiver, right? Till this concept is developed by Luca Pacioli, the Italian, there was only single entry. Okay. You purchase material, materials purchase, that's it. When you buy the material comes in, but you also have to observe or notice that the cash is going out. That's not recorded. Okay, that's not recorded. There's a cash going, there's a material coming. So these two things were not recorded earlier, but it is only after this dual aspect concept. Okay, for every debit, there's a credit. If there's a giver, there's a receiver. If there's a receiver, there's a giver. This is the understanding about dual aspect concept. Very good, ma. Next. Yeah, you can take this example. This is example. Dominic, continue.
Yeah, yes, sir. For example, the proprietor of a business starts his business with cash rupees 1 lakh, machinery of rupees 50,000 and building of rupees 30,000. Then this fact is recorded at two places, that is assets account cash and machinery and building and capital accounts. The capital of the business is equal to the assets of the business.
Got it? Yeah, this is the dual aspect concept, the crux of dual aspect concept. Liabilities plus capital is equal to assets. You have your own money, that's capital. You are keeping your own money into the business, that's capital. And you borrow some money because your money is not sufficient enough to start the business. So therefore you borrowed money from the bank. That's liability. So capital plus liability is equal to assets. You buy the long-term and short-term assets, the fixed assets and the current assets. So the assets should be equal to the capital and liability, right? Dual aspect concept. If there's a giver who is giving financial resources, okay, who is giving capital and liabilities, who is taking assets or taking, right? With the money that is raised through bank loan, that's liability, and raised through capital, okay, is spent on asset. It is spent on assets. Okay. So, this is also known as, look at this one. This is also known as accounting equation. We've discussed in our exercises, right? we have discussed in our, previously we have done some exercises, right? So there was a fill up the blank like this. Look at this. Capital may be blank. Blank plus liabilities is equal to assets. Then the blank should be filled with capital. Or capital plus blank is equal to assets. You should fill with the liabilities. Capital plus liabilities is equal to blank assets. So this is how, the permutations and combinations, happen with this equation, accounting equation. There are 3 bits that you can learn. Okay, any question may come out of these 3 in the internal examination, right? And not only that, internal examination, when you're preparing for the internal examination, it is also you're preparing for the interviews. You're preparing for the interviews for, for your master's program or for your jobs. These things will be useful. Nobody will ask you, prepare balance sheet, prepare income statement. Nobody will ask you, because in the time available, there is a minute or half minute. In that half minute, you had to demonstrate your skill. Okay, this is how. Can you tell me the accounting equation? You should, without any hesitation, you should be able to say assets is equal to liabilities plus capital. Okay, that's how you should say. Next is, who will read this? Who will read this? Who will read this?
So,
yeah, read.
Realization concept. The concept emphasizes that profit should be considered only when realized. Accounting should take into consideration profits only when the same have been realized.
Yeah, realized. What is realized? What is realized? You make out your profit, right? Let's say you sold goods worth 10 lakhs. Out of that, you have suspected 2 lakhs to be doubtful. Okay, out of those 2 lakhs doubtful, 1 lakh really did not pay anything. They have purposely or intentionally, they have evaded that payment. What is that? That's a bad debt. Debtors of 10 lakhs, you made a provision of 2 lakhs that you will provision for what? For doubtful debts. And your doubt proved right 50%. That is, out of 2 lakhs, 1 lakh did not pay, right? So what is that called that you did not receive? You did not receive, right? Are we exceeding the time? Yeah, please do let me know.
No, sir.
Yeah, okay.
You have still 15 minutes.
Yeah, thank you. So, yeah, this is what you cannot recover is bad debt. What you cannot recover is bad debt. Okay, so this concept emphasizes that profit should be considered only when realized. You cannot realize this 1 lakh. Okay, so when you cannot realize, you cannot count that as revenue. The amount collected on the cash sales and the credit sales, that's debtors, from the debtors, it's revenue, right? You cannot consider that as revenue. And if you consider that as revenue, the profit that you see is not realistic profit. It's a profit defective. It's unrealizable profit. Okay, so you must recognize the profit. You must recognize the profit only when they are realized, right? The accounting should take into consideration profits only when you are able to realize those profits. Realization concept. Okay, realization concept. Matching concept. Can anybody please take up this?
Matching concept.
Yeah.
Matching concept requires that expenses should be matched to the revenues of the appropriate accounting period. So we must determine the revenue earned during a particular accounting period and the expenses incurred to earn those revenues.
Thank you. Yeah, good. So look at this. What Janvi says is, you should be matching your expenses against the revenue so that you make out whether you made a profit or a loss. Your expenses are matched against the incomes. Okay. Now, very often there is a confusion that people, yeah, look at this. People have a confusion, not just students. They write the explanation of matching concept to the dual aspect concept and explanation of dual aspect concept to the matching concept. This is a temptation. Now, I'll give you a shortcut for this. The shortcut is you treat this for balance sheet. Dual aspect concept belongs to the balance sheet. All liabilities should be equal with assets, right? Look at this. All liabilities should be, including capital, should be equal with assets, right? You cannot spend more than what you have. Therefore, the balance sheet should tally. It's a dual aspect concept. There's a receiver and there's a giver. For every debit, there's a corresponding and equal credit. This is dual aspect concept. This should not be mistaken with matching concept, right? Now, this is a confusion not just for you, even for the teachers who are teaching for 5 years also. They tend to commit these mistakes. 5 years, 10 years, right? Matching means matching revenues, expenses against the revenue, right? So that you can make out whether the company is making a profit or loss. So when it is profit or loss, then expenses and revenue, what is this? This belongs to the profit and loss account. Okay, let's conclude. The dual aspect concept belongs to the balance sheet. Matching concepts belong to the profit and loss account. You remember this way, then you will be able to recollect, okay, what we have discussed, and you can go on scribbling on your answer books, right? Next is accrual concept. Accrual concept. Accrual concept is, yes, can anybody take up this? Accrual,
Sir,
yes, please.
if you don't mind, once can you explain again the matching concept and
Okay,
the difference between both of them?
yeah, you know, matching concept tells that you have to match the expenses against the revenue. When you match the expenses and revenue, expenses and incomes only, you will make out, you will come to know whether the business made a profit or loss. Without matching the expenses with incomes, you will not be able to make out whether the company has made a profit or loss. So therefore, you must match periodically. Periodically, you have to match, right? This is matching concept. And let's come to the dual aspect concept. Dual aspect concept is all liabilities should be equal with assets. All assets should be equal with liabilities. The balance sheet should tally is dual aspect concept. Okay. There should be debit of expenses, credit of incomes. That is matching. Okay. Matching concept belongs to the profit and loss account. Dual aspect belongs to the balance sheet. Done, ma? Is that okay? Okay. Next. Accrual. Accrual concept. Accrual. What is accrual? Okay. Will anybody read this? Will anybody read this?
Accrual concept. Accrual is concerned with expected future cash receipts and payments. Accounting attempts to recognize non-cash events and circumstances as they occur. Examples are purchase and sales of goods on credit, wages and salaries outstanding.
Yeah. You know, whether received or not, whether paid or not, once the expenses and incomes become due, you will record. That's a rule of this concept, accrual concept. Accrue means becoming due. Once these things, items become due, whether it is expense or income, we record in the books of accounts. That's it. Okay. So when you sell goods, when the invoice is generated, that's it. It is implied that there's a sale took place. Okay. When you buy the goods and the purchase order is accepted and they have supplied the goods and the goods have come to your premises, to your go down, you have to treat it as purchase of material, right? Till they reach, once they reach your premises, that's purchase, right? So this is accrued. Then you have to record in your books that you have purchased so-and-so material with so-and-so amount. That's accrued. Salary, sometimes you might not pay salary, but it may become due. You have to record. You may pay salary after 2 months, doesn't matter, but it has become due. It's an expense for the company. So whether you pay or not, once it becomes due, you must record. Okay, that's a concept, accrual concept, accrual concept.